Hi guys, this is Mark McRae and we are continuing to look at financial ratios and why they are important. What we're trying to achieve is to build a dashboard of relevant information that will be used by you, the owner or the CEO of a company, and what's important to you. So today we'll have a look at the gross profit margin and some other ones. So the operating profit margin measures the proportion of each sales dollar that is available to contribute to the bottom line after all operating expenses have been paid. It is calculated by dividing operating profit or income by the total revenue. So gross profit margin, the higher the better, obviously. I had a conversation once where a guy was going to buy a business and it had a 90% gross profit margin, and he said, how can you go wrong if you've got, it's impossible to fail. You can fail, a business can fail regardless of what the gross profit margin is. You could have a 98% gross profit margin and still not be successful. If the expenses so if you have something, let's say you have a widget and you sell it for $100 and it has a gross profit margin of 98%. If it costs $200 to sell that $100 product, it still won't work. But it's very important you know where your margins are, and generally the higher the margin, the better. So operating profit margin. The operating profit margin is a measure of how much money a company makes from its main business activities after paying for all of expenses. It's typically measured over a year. So you would get that calculation by looking at the operating profit, right, before tax, the operating profit divided by the sales, and that will give you a number, typically a percentage. And so your operating profit margin is something that you can monitor and compare with other companies. If you're looking to buy other companies or invest in other companies, it's an important number. The net profit margin is even more important. So the net profit margin measures the proportion of each sale dollar that contributes to the bottom line as net profit after all expenses, including taxes, have been subtracted from the revenue. So in some ways, it's a more important number. And that's calculated by taking your net profit divided by sales in order to get a percentage. And one of the ways that I find these numbers to be important is if you have a look back over a certain period of time, then you can see how efficiently your business is running. And the last one we'll look at here is return on assets. So the return on assets, or ROA, is a ratio that measures the return generated by a company's assets and is calculated by dividing the net income by total assets. Okay, and it depends, again, each business is different in how it uses and deploys the assets that it has, but it can be a very important number to look at. So always, in nearly all of these ratios, the higher the number, the better. So if you have a high return on assets, it can be a calculation that people look at, particularly when they're looking to buy a business or you're looking to exit. Hope that helps. The best place to see these tips is have a look for me on YouTube. Look for Mark McRae. Don't forget to like, share, or subscribe wherever possible. Thank you.